Okay, we're going to take a look at exercise 10-8. I picked this one because there's a little quirk in this one that's different from the ones we've looked at already. So, Camping Supply Company developed a new camping lamp, runs on solar power, blah, blah, blah. Okay, so here they've established the following standards related to the new camping lamp. Direct materials, 3 small solar cells per lamp at 60 cents per cell. Direct labor, 0.75 hours per lamp at $12 per hour. So during the month of March, the company produced 4,000 camping lamps. Then we're given production data. So direct materials, 20,000 small solar cells were purchased at a cost of 65 cents per cell. 6,000 of these were still in inventory at the end of the month. There was no opening inventory. So this is something we haven't seen yet. Direct labor, 3,100 direct labor hours were worked at a cost of 35,000. Compute the following variances. So direct materials, price, and quantity variances. So what we have to take note of here is that a different amount was purchased than was actually used. 20,000 cells were purchased, but 6,000 of those are still in inventory, so only 14,000 were used. So this here then, our little, if we do it by the chart, it's going to be a little bit different than what we looked at before. So to work out our price variance, it's actual quantity times actual price, and actual quantity times standard price. Here for quantity, because we're looking at the price, we're going to compare them using what was purchased. So actual quantity, 20,000, times actual price, 65 cents per cell. That gives us 13,000. Or actual quantity, 20,000, times the standard price, which was 60 cents per cell, which works out to 12,000. So they paid 65 cents per cell. The standard allowed for 60 cents per cell. They paid more. So it's unfavorable, which you can verify by 13,000 subtract 12,000 would give you a positive number, which is unfavorable. Now when we want to look at our quantity variance, here we're looking at the amount that was actually used. So instead of, you can see what we have done here, we have our price variance, and then they have another calculation here. So we're not comparing this to this. We're going to come down now and we're going to calculate this one again, this middle one. But now we're going to use 14,000 because 14,000 was actually used. So 14,000 is our actual quantity times standard price, which is still our 60 cents per cell, which gives us 8,400. Standard quantity times standard price. So standard quantity is, okay, so we're not given it directly. We're given the how much they should have used per cell, but we're not given the total, so we have to work that out for ourselves. So 4,000 lamps, 3 cells per lamp is 12,000. So our standard quantity that they should have used for the actual amount of output that was done that month is they should have used 12,000 cells, and our standard price is 60 cents per cell, which gives us 7,200. So we're comparing our 7,200 here with the 8,400 here. So 8,400 subtract 7,200 is a positive number, positive 1,200. It's unfavorable. And again, you can look and say our actual quantity was higher than our standard quantity. So therefore, our actual was higher, it was unfavorable. So whichever way you want to look at it, or you could just, if you think it through like that and then you get the number that's in the right direction, you kind of know you're on the right track. Or again, you can use your formulas. Materials price variance, so actual quantity times actual price minus standard price. So actual quantity, and again, because it's our price variance, we're going to use the actual quantity that were purchased. So 20,000 times actual price, 65 cents per cell, minus the standard price, which was 60 cents per cell, gives you a negative 1,000. Negative number, oop, that's not right. That should not be a negative. It's a positive number. So there's an error here because we already worked it out. It is unfavorable, which means this should be positive. Okay, so just when you're looking at this question, that there is incorrect. And the quantity variance is standard price times actual quantity minus standard quantity. So standard price is 60 cents per cell. I'm just looking at this here. I don't know what this word is. DIODE. It's per cell. Okay, so anyway, actual quantity. Now this we're looking at now is the quantity that was used in production. So that's 14,000. The 20,000 purchased minus 6,000 remaining. Minus your standard quantity, which is 12,000, and except that wasn't given to us directly, but we calculated it out here. So if you do that, you will get a positive 1,200 and positive number, unfavorable. So again, you can do whichever method you like, you find easiest. Yes, there's a part B. We need to do the direct labor rate and efficiency variances. So down here. So actual hours times actual rate. Now, we're given the actual hours. We're not given the hourly rate, but we are given the total. So again, you could have been given the rate and you have to multiply it to get the total. We can still get the total if we need to. It's just 35,000 divided by 3,100 hours, but we don't really need to do that for this part because we're given the total number anyway. So 35,000. Actual hours times standard rate. So actual hours 3,100. Standard rate is standards up here, $12 per hour. So that's 37,200. Or standard hours times standard rate. Standard hours. Again, we're not given the standard hours, but we're given how much per each lamp. So we know that they made 4,000 lamps, and each one should have been 0.75 hours. Yes, down here. So that's 3,000 because it's standard hours allowed for the output that was actually done that month. So at 4,000 lamps, they should have used 3,000 hours times your standard rate at $12, which is 36,000. So the first two, 35,000 minus your 37,200, that would give us our rate variance. So if you do that, you get a negative number. The negative is actually not put in here, but it's a negative 2,200. Negative number means favorable variance. 37,200 subtract 36,000 would give you a positive 1,200. Positive number means unfavorable. The first ones here is what you use to calculate the rate variance. The middle one subtract the last one here is what you use to get your efficiency variance. You add them together to get the total variance. Or you can use the formulas. So labor rate variance, actual hours, 3,100 times your actual rate. And we're not given the actual rate, but like I said earlier, it's 35,000 divided by 3,100, so that's 11.29 per hour. So actual rate minus standard rate of $12 per hour, or your labor efficiency variance, standard rate $12 per hour times actual hours 3,100 minus standard hours, and standard hours we calculated, I think, yes, right up here at 3,000 hours, you get 1,200. So just remember, if you, and oh yeah, the number here is slightly different and it's due to rounding, this they're saying here, but if you get a positive number, it means it's an unfavorable variance. If it's a negative number, it's a favorable variance. That works both ways here, but here it's just a bit more easy. It's a little easier to visualize and see. Okay, so that's it for that question.